Hello and welcome to the fourth quarter video podcasts of the New Jersey Bank Marketing Committee of the New Jersey Bankers Association. I'm your host, Steve Lubetkin from ProfessionalPodcasts.com. In this podcast, the second of three from the fourth quarter 2008 series, a presentation on the economy by Michael Horn, chairman of the Federal Home Loan Bank of New York. This program was recorded December 4th, 2008 in Clark, New Jersey, and runs about 35 minutes. For information on New Jersey bankers, visit NJBankers.com. For the Bank Marketing Committee, visit NJBankMarketing.com. Now let's go to the lectern where Jane Gore will introduce Michael Horn.
Our next speaker is Michael Horn, who's chairman of the Federal Home Loan Bank of New York. He was elected in May of 2008 and serves as the board chair. He was most recently appointed to serve as a public interest director on the board of the Federal Home Loan Bank of New York by the Federal Housing Board in 2007. He previously served on the board from 1988 to 1999, and again from 2002 to 2004. He has been a partner since 1990 in the Newark, New Jersey office of McCarter & English, a law firm with 400 lawyers in 7 states. He was the Commissioner of Banking for the state of New Jersey from 1982 to 1984, and was the state treasurer from 1984 to 1986. Mr. Horn earned a bachelor's degree from Princeton University and a law degree from Harvard Law School. The Federal Home Loan Bank of New York is $109 billion AAA rated. This all may have changed, but this is what.
Investors were growing.
Oh, okay. Congressionally chartered wholesale bank. It is part of the Federal Home Loan Bank system, a national wholesale bank network of 12 regional stockholder-owned banks. Federal Home Loan Bank of New York serves 293 community lenders in New Jersey, New York, Puerto Rico, and the U.S. Virgin Islands. The mission of the Federal Home Loan Bank of New York is to advance housing opportunity and local community development by maximizing the capacity of the community-based member lenders to serve their markets. And I bet he's being challenged now. Mr. Horn.
Thank you, Jane, and it is nice to follow Kevin, because a lot of what Kevin said illustrates some of the things I will talk about. I appreciate the opportunity to be here. It was either Kevin or the person who opened up the meeting used the word crystal ball, and you're right. When we were first asked, at least when I was first asked, to speak at this event, was like 5-6 months ago, before the meltdown, although we knew we had problems at that point. As you know, it started in, August of '07. And, but it reminded me about, I don't know, about 10 years. We joke about crystal balls. About 10, maybe 15 years ago, my wife and I were vacationing up at the Thousand Islands, and there's a place there called the Thousand Island Country Club. It's like a hotel, and so we stayed there. We drove up there. We checked in before dinner. We decided to have dinner off-site. We went to a local restaurant and came back in. It was dark by that time, and we walked in. And you know how you do when you check into a hotel you've never been in before. You walk around the lobby, see what's here and what's there. And we walked into a semi-dark room, and we realized as we stood there, having walked in the door, that we were in a seance. And everyone was holding hands, and there were crystal balls, and we thought it was interesting. We thought maybe we were intruding, so of course we walked out. The next morning, when we went for breakfast, and this is true, people were actually carrying real crystal balls to breakfast, putting it on the table. So there are a segment of our population who do believe in and have crystal balls. Now, I don't have one, but I'm going to do the best I can. And the only other thing I say is you have a great challenge, those of you who are involved in marketing now. It's very, very difficult, but as Kevin said, great opportunity, and I hope to emphasize those opportunities as I speak. Jane, I thank you for explaining what the Federal Home Loan Bank is, up until, I guess, a couple of years ago, unless you were a banker, no one ever heard of the Federal Home Loan Bank. And yet, for over 70-something years, we have providing liquidity and helping banks like Investors and your own banks provide housing funds for mortgages and community development. For example, the paper mill kind of loan that Investors made. And I don't know if that's the case in this loan. What we do is we provide funds at cost to banks to help their community development with organizations like the Boys Club, Girls Club, Paper Mill Playhouse, and the like. And the important thing to understand about the Federal Home Loan Banks is we are owned by you banks. Our stockholders are the banks, and how much stock you own depends on how much borrowing you do from us. So if you do a lot of borrowing, you have a lot of stock. We pay a very nice, have been fortunate in most times to pay very good dividends, and so we feel we play an important role nationally in enabling banks to loan to their communities. And as we have found out over the last year, when lending decreases, the economy suffers terribly. These are times of extraordinary stress in the mortgage and credit markets. Needless to say, neither Kevin nor I nor anyone else in this room has ever seen such turmoil. Beth Fitzgerald is here, and 3 weeks ago I from NJBA was here, and I think you were there, Beth, and I spoke in Somerset County, and the title of that talk, I don't know if it was the title, but I listed about 15 causes or things that contributed to the crisis that we're in today. Of course, the major one was the collapse of the residential mortgage market, but then I listed all the factors that led to the collapse of the residential mortgage market, and I don't intend to repeat them today, but I may mention a few as we get there. As I mentioned earlier, this all began in August of 2007, and so we're now in the second year of a financial crunch, I guess is one way to call it. It's interesting, no two people call it the same thing, call it a meltdown, financial crunch. Yes, we are in a recession, and whether we were in it for a year, as the press tried to say, ex post facto 2 days ago, we're clearly in one now. And as I said earlier, it was caused by the ending of the housing boom. Some of the reasons that caused that were, as Kevin mentioned, underwriting deficiencies, credit rating agencies had played their part in it, mostly with respect to subprime mortgages with adjustable interest rates. And as the next 15 months unfolded, the excesses of the subprime mortgage lending initiated what we now call a meltdown. But it pointed out some of the mistakes that were made in the years leading up to the meltdown. Risk was either ignored or underpriced. Kevin mentioned properly so, risk averse is a good quality. Leverage was excessive. It's interesting, you are all mostly, or perhaps all of you, in banks. The investment banks were way over leveraged. They not only packaged all the subprime loans together, they held a lot of them, some on their balance sheets, some, Kevin, I don't understand how they were allowed to keep them off their balance sheets in these vehicles. But be that as it may, leverage was excessive, and when it started to unravel, as you know, some of the major investment banks did not have the capital to absorb it. And many people begin to mix up banks, which are highly regulated as to leverage, and investment banks, which weren't at the time or escaped whatever regulations they had by putting the mortgages off balance sheets. And that's bad because you're the good people, and by and large, except for the large ones that we all know, banks, community banks, didn't cause the problem, didn't suffer the problem, and continue to support their communities, while a lot of the larger institutions no longer do so. So the unwinding began. Severe financial strain, tight credit are now limiting economic growth, not just in the United States, but across the world. As I mentioned earlier, part of it was we were over-leveraged, the economy was over-leveraged, and we immediately went to because of the subprime crisis, the markets became frozen for a while. They're starting to thaw, which is good. We did have the failure of some major institutions, forced mergers and the like. The big question, of course, and the one that just as no one predicted where we are that we'd be today where we are today, I don't know of anyone who, I know people make predictions, but they're all over the place, and I don't know if there's anyone who can tell you when this will end. I'd like to believe that we're on the upturn now. I think the thaw, there is a bit of a thaw. I must admit and congratulate the government, with I think one major exception, has done well in preventing further deterioration. I think the government and the Fed and the Treasury, they did their best in unprecedented times. And I think with the exception of allowing Lehman to fail, I think that turned out to be, in my mind, a mistake. They've done pretty well. And the good news is, as Kevin mentioned, community banks are still making mortgage loans, not only home mortgage loans, but commercial real estate loans and some commercial loans as well. They're making them under, although banks like Kevin have always had high standards, community banks are making loans under higher standards than some of them did in the past. They're making commercial real estate loans. And a couple of weeks ago, I was asked to speak at a group of northern New Jersey commercial real estate companies, and the way they set it up was they had 4 community banks and me, I was the moderator, on the dais, and each community bank in turn told what kind of lending they were due. They were inviting lending. People were exchanging cards. So one of your challenges is people don't think that mortgage money, particularly commercial real estate mortgage money, is available, but it is available under proper lending standards. Those with weaker credit histories will still have a problem. When the securitization market for private label mortgages, mortgage-backed securities shut down, Fannie Mae, Freddie Mac, and Ginnie Mae are the only conduits now through which mortgages can be securitized and sold to investors. The government is doing its best to keep these organizations going because if we're going to work our way out of the residential real estate market, we have to have a free-flowing ability for banks not only to originate and hold, but originate and sell mortgages as well. And right now, Fannie and Freddie, though in receivership, are our best hope until other avenues of securitization begin to take shape. It's very interesting, and as Kevin did, you look back, when I was in the State Assembly and as banking commissioner in the 70s and 80s, all mortgages, or almost all, were financed by the capital, no mortgages were financed by the capital markets. They were mostly held by the banks. Community banks gathered deposits, used those funds to make mortgages. A little bit about what's happening in Washington. One of the major factors that led to the meltdown was the collapse of Fannie Mae and Freddie Mac. This is a failure of Congress. For years, responsible bankers and others have been saying that the business model that Fannie and Freddie had was unworkable. And I can remember sitting at board of director meetings at the Federal Home Loan Bank of New York, and I remember one of our former chairmen used to say, boy, it's going to be some mess when Freddie and Fannie go. And at some public hearings a year or two before the collapse of Fannie and Freddie, the president, to his credit, and the Bush administration saw what was happening and tried to pass legislation which would provide stricter regulation over Fannie and Freddie. It ultimately led to the Housing and Economic Recovery Act, but that came too late. It came after the failure. This act created a new regulator for Fannie and Freddie, but also the Federal Home Loan Bank system. And it's just like some of your banks are now being mixed up with what happened on Wall Street. We find that one of our challenges is at the Federal Home Loan Bank, which is a healthy, thriving system, to separate ourselves from Fannie and Freddie. It used to be, they used to say the 2 GSEs, Freddie and Fannie, and the 12 Federal Home Loan Banks. We were separated. Now they say the 14 GSEs, so they put, because we all now have the same regulator. But we are a strongly capitalized system of banks, and as I said, it was described to you earlier. I'm proud to say that the Federal Home Loan Bank system has filled a lot of the void during this critical period. We have increased our lending to our community bank members substantially. We do our borrowing through a central office. All 12 Federal Home Loan Banks do our borrowing together through a central office in Washington. And between that borrowing and the capital stock that our members are required to purchase, we then lend to banks like Investors and others. We've done this in an increased capacity since this crisis started in the summer of 2007. For example, just the capital, not the lending, the capital of the Federal Home Loan Banks has increased, the 12 banks, from $44.6 billion in 2007, June 30th of 2007, to $56.6 billion a year later on June 30th of 2008. We have stuck to our knitting and quietly supported the thousands of community bank lenders, which are your employers, each day who make well-written, underwritten, prudent loans to families and businesses. During this crisis, and this is what I'm proud of, we have provided more than $350 billion in additional liquidity to the banks we serve. So whatever we did before August of 2007, we're now lending more than $350 billion to your banks so that they could in turn lend it out to your communities and help the economy. And at the end of the third quarter of 2008, the Federal Home Loan Bank system held over $1 trillion in advances to our banks. In New York, and this was mentioned, we cover New York, New Jersey, Puerto Rico, and the Virgin Islands. In the last 15 months since this all started, we increased our lending to banks in our district from $60 billion to $100 billion at the end of the third quarter of this year. For New Jersey, just looking at New Jersey, we went from $20.8 billion in loans to banks in New Jersey to 37.4. So that's an increase of approximately $17 billion over the 15 months. And it's in terms of percentages, it's an 80% increase. So where do we go from here? To keep the economy moving, two things have to happen. Credit must continue to flow, and your banks are providing that credit to community and families. And the financial system must operate in a safe and sound manner, and that seems to be happening. Kevin mentioned some C's. We have 4 C's: capacity, credit, capital, and collateral. That's at the Federal Home Loan Bank level to our banks. Now, there are challenges, and so I need to go over some of those challenges with you. Jim Hughes, who's dean of the Blaustein School of Planning and Public Policy at Rutgers, told a New Jersey Senate committee on November 10th, he said that the slump is likely to continue at least through March 2010 and could last until February of 2011. Now, I respect Jim Hughes. When I was state treasurer, he was one of my economic advisors, and he's very skilled and very good, and we're very lucky to have him in New Jersey. But I don't know how anyone can predict when this is going to end. I'd like to believe that because the way the financial markets operate today, where you can move billions of dollars with the touch of a computer stroke, that things went down faster than they did in the old days. I think on the opposite side, things can get better more quickly than in the old days. So I wouldn't begin to tell you whether March 2010 or the end of 2009 or the summer of 2009, but things will turn. And the important thing is this: it has always turned in this great country of ours. It's just a question of when. And with both the past administration and the new administration, which I'll talk about in a second, it will turn again. We do have some problems in New Jersey. Professor Hughes said that the future job losses in New Jersey will be between 67,000 and 246,000. I'll quote him. He said, "Economic wild parties are often followed by prolonged economic hangovers." We are now in the early hangover stage. Correcting all of Wall Street excesses will take a considerable amount of time. Again, I don't know how much time it's going to take, and as I said, I'd like to believe it'll come back more quickly than we think. The Obama administration appears to be hitting the ground running. The selection of Tim Geithner, who is attained universal praise as Secretary of the Treasury. He has put together an experienced, technically proficient team, and it inspires confidence, which I think is good. The President-elect said himself on November 24th, "We are doing whatever is required to stabilize the financial system," and I think that's a commitment that exists currently in the administration and is going to be a top priority for me during the transition, as well as once I take office. Even as we focus on making sure the financial system is stable, we will also recognize that a strong Main Street will reinforce and help a strong Wall Street, and we can't separate the two. So our governmental leaders are focused on improving the economy. There are a lot of good things happening. The population of the United States today is 304 million. In 2014, it's expected to grow another 15 million people. New Jersey, we have had a problem in population growth. We have that's for another talk someday about the anti-business climate and the anti-wealthy person climate in New Jersey. but Professor Hughes said that the population is expected to grow 5.8% per year until 2014. I don't believe that. I think we're losing too many of our wealthy people because of our bad tax system and other things which discourage wealthy people and businesses from staying in New Jersey unless they have to. At any rate, we have had large increase in immigrants into the state, which is good for the economy. We will get through this, as again, we always have in the past, and it's just a question of when. So I am optimistic. Today's uncertainties will end. Both federal and state governments are developing comprehensive approaches to address
auto industry. And the second part of the question is, if the auto industry does fail, what impact will it have on the state?
Well, let me answer that in two ways. First, once that reaches the bottom, then prices will begin to uptick and the recovery will begin. Demand for homes will resume. So, yeah, we have a real bad problem now. We may be, I think, on the way up, but it will get better. Thank you. Before I ask for questions from the floor, I'm not a good joke teller, but I love this one. I was going to try to make it gender neutral, but you can't. The guy calls his wife from work and says, I'm going to work late tonight, but I'll be home early, 9, 10, something like that. At 2 a.m., he stumbles into the house, reeking of alcohol, falls across the threshold onto the floor, and standing in front of him is his wife. And she says, well, what do you have to say for yourself? And he says, well, I don't have any prepared remarks, but I will take questions from the floor. So are there any questions from the floor? Yes.
Clearly, the mortgage mess was a result of a combination of factors like loosening of standards, moral hazard, rating agency issues. My question is, as it relates to regulation, would you characterize the issue as a result of a lack of regulation or ignoring regulations that currently exist? And I know that's
It's a great question. With respect to regulated financial institutions, which I assume 98% of you are in, they're already well regulated, and that did not cause the problem. What was unregulated were unregulated mortgage bankers and brokers around the country, and a lot of the activities of Wall Street escaped regulation. So when they talk about re-regulation or fixing the regulation, banks can't be any more regulated than they are. I'm sure Kevin will agree with me. They're regulated in every way, shape, and form and examined to the utmost. So yes, we should regulate our mortgage bankers and brokers more. And yes, some of the activities of quote, investment banks have to be regulated more. But banks, and again, as a general matter, banks didn't cause this problem. But you all hear some of the, but there's so many causes, and Kevin mentioned one in a different context, incentive compensation. There are these buzzwords. Every 2 or 3 years there are buzzwords in management. One of them was incentive compensation, compensate people for their production. And so what was happening around third quarter of each year, Wall Street would call whoever was feeding them subprime mortgages for securitization, and they'd say, hey, we'll pay you more if you can get us some more high interest. And how do you get high interest? People who with higher risk mortgages. And I know people say that these people who got mortgages, made their own bed and they should lay in it, but they were really sold a bill of goods, both by realtors and mortgage bankers, when they said, but I can't afford it when the rate goes to 9%. And they said, well, but by that time your house will be worth 40% more. We'll refinance it. Da-da-da-da-da-da. So, and yeah, we need some more regulation, but not at the bank level. Any other? Yes.
Did the government bail out the auto industry? And the second part of the question is, if the auto industry does fail, what impact will it have on this state?
Well, let me answer that in two ways. First of all, the government will bail out the automobile industry. Michigan and the states around it were important in the primary election and the general election, and those states, they're going to be bailed out. Whether I think that they should or not, I think I speak along with a number of other people who say, under changed circumstances, I know there's only so much you can ask from labor and others, but they are going to have to be, if not a formal bankruptcy, some system of reorganization which will make them competitive with the foreign-owned auto manufacturers. So it's going to happen. Was there a second part to that question? I remember. Yeah.
The second part of the question is, if the auto industry does fail, what impact would it have on the state?
We've lost most, I think, of our auto manufacturing ability. We used to have those plants out on, was it Route 1? Edison, yeah. I don't know if Mawa, is Mawa still there? Yeah, so I don't think it's a New Jersey. It's a national issue, and I understand the arguments about the suppliers and everybody else. And we all know the executives of the auto companies. At least this time they didn't take private planes to Washington, and there's got to be some change there too. But it's going to happen, and because of the effect on the allied companies, it probably makes sense, even though it hurts. I mean, are we going to bail out every industry? I mean, where do we stop? And that's behind your question. There was another question back there? Yes.
Mr. Cummings had mentioned the potential for 4.5% mortgages. I was wondering if you could comment on the potential, the impact, and any role the federal home loan might have.
Good question. I heard that on the radio on the way in, but because I was preparing to speak this morning, I didn't read the papers this morning, so I don't know any of the details. They're apparently, they'd have to be subsidized. There have to be a federal or some other subsidy. We borrow in the capital markets, and we have to charge more than we pay in our interest rate. Now, our borrowing has the implied and perhaps the actual backing of the federal government. So we borrow at very favorable rates. That's how we're able to provide advances to banks at very favorable rates. But and we will do that. But in terms of 4.5% mortgages, unless that becomes the market, and maybe someday it will, that has to be subsidized somehow. Well, thank you very much.
We hope you enjoyed this presentation by the New Jersey Bankers Association's Bank Marketing Committee, produced by ProfessionalPodcasts.com. For information, call us at 856-751-5491 or send email to steve@professionalpodcasts.com. Thank you for joining us, and we'll see you out there on the net. Take good care.